Hey everybody, Friday, TGIF, what's going on? What we're going to talk about today? Jobs numbers, the jobs numbers. I have to admit that I put out my forecast last night. It was way off the mark. My forecast was 217,000. It came in at 130,000. Now, a lot of times my data, the numbers I look at, and it's a whole broad range of numbers. For example, employment and withholding tax deposits, the increase or the decrease from 1 month to like August to July, and then August 2019 over August 2018 to see the comparisons there. Weekly unemployment claims, unemployment benefits paid out, a whole bunch of stuff. And it showed strength. It showed surprising strength. And also on Wednesday, we saw that the ADP payroll number was much higher than what the consensus forecast was. It came in at what, 195? I think the forecast was like 150 or 145, something like that. So my numbers were strong. All right, that's how come I had a high forecast. Now, a lot of times with my numbers, it could be picking up on the increase in wages, in earnings. And indeed, we saw in this report today that wages were average hourly earnings were up 11 cents. Now, that was the fastest rise in a year, or the biggest increase in a year since October 2018. And hourly earnings are growing at 3.2% year over year. That's much higher than the inflation rate, right? The inflation rate is under 2%, right? The Fed is always talking about that's their target. So what we've seen, and normally, by the way, when you have wage growth above the inflation rate, the inflation rate tends to converge to the growth pace of wages. So here's the question. Why was the payroll number so weak? Now, a friend of mine hypothesized, and I thought it was a pretty good hypothesis, saying that companies are finding it hard to find workers. All right, the job market, the pool of available workers is getting smaller and smaller. It is shrinking. And anecdotally, like I've spoken to people running small businesses here around the neighborhood where I live, you know, they're finding it hard to fill certain positions. So that could explain, we've had a few months now of these kind of low-end payroll numbers, but at the same time, you see wage growth creeping up. Now, if the low payroll numbers were really an indication that the economy is slowing down, what would happen? You wouldn't see wage growth picking up. You'd see that slowing down as well. So I thought that was a pretty good explanation. All right, market's up again today. Folks, we are in this period now, this kind of sweet spot. And again, I'll repeat, the August 8th was the bottom. And I said that back on June 26th. I said August 8th would be the buy window because that was the reserve peak, the peak in bank reserves. And when they start coming down, that is a bullish. And I think I've explained that many, many times here. The relationship or the interaction between those flows, those reserve flows between Treasury and the banking system and then back again, and how that affects bank assets and how they have to adjust assets. You know, you're talking about over 17 trillion of assets. So when banks, when they get these inflows of reserves or when reserves come out, it causes them to do certain things, and that supports the market or takes support away from the market. These are all tradable patterns, as I've said in the past, and I put out this information as part of what I do in my report, MMT Trader. And nobody else does this, not even any of the other MMT people. As a matter of fact, I would say that all of them universally ignore this or don't understand it. All right. And it's interesting that some of the top MMT people now are not really talking about the fact that the deficit is about $1 trillion. Their big thing is the deficit. I've never been one really to lean on the deficit because the deficit is what is left over after the spending and then the government taxes. It's basically savings of the non-government, or part of the non-government savings. I look at the flows, all right? The flows are what counts, the spending. And as I mentioned the other day, we had that slow period in August related to the debt ceiling, and then boom, it just took off again recently. So we are going up, the market's going up, we're in an up mode until a certain date. And I have that date. I already have the date. If you want the date, you have to sign up for a 30-day free trial of MMT Trader or Zombie Trading. Oil back up today after getting hit. Yesterday I said buy the pullback. Yeah, yesterday was classic. Let me tell you, as a trader, as somebody who's been trading, and I've been a floor trader for many years, way back when, it was classic. You had the 4.8 million drawdown in the EIA report. All the zombies jumped in long the market right at the top at $57 something, and guess what? It came right back down. They all puked it out. And I said, you got to buy it when it comes back down. We went down to low 55 handle. Now we're almost back up to 57. The rig count came out again. No, not again, but I mean every Friday rig count came out. Down again for the third week. That's been down for 9 of the last 10 weeks. It is at the lowest level. The rig count now is at the lowest level since November 2017. And the gas rig count is at the lowest level since March 2017. All right. So what's that? 30-month low. A 30-month low in the natural gas rig count. And what? 9, 10, 22-month low. Right? Am I right about that? No. What am I saying? 9, 10, 11-month low in the no, I was right. 22-month low in the oil rig count. So yeah, that's bullish. What else? Dollar stable today after a day or two of falling. Next week is going to be big, folks. We got the ECB meeting, and that is supposed to be a big quote-unquote stimulus. Of course, those things are not stimulus in any way. We've seen that. As a matter of fact, part of the reason for the slow global growth has been monetary policy. Hey, you want to talk about some good monetary policy? I'll tell you something. The Bank of Canada earlier this week said they're not interested in lowering interest rates anymore. They feel that interest rates at where they are, which I think is what, 1.75%, 1.75%, I think where the Bank of Canada rate is. They said they're fine with that, and that is something refreshingly bullish to see. Instead of all these central banks going to zero rate, negative rates, asset purchases, all of those policies, as I've explained in the past, are detrimental or deflationary to economies, right? They remove income, they remove assets, the highest quality collateral that financial institutions and other entities need. They take that away. We see it in all these systems, Japan, Europe, okay, where the central banks have been running policy that has been counterproductive to the goals that they're trying to achieve. They've been sucking income and assets out of their economies. The negative rates effectively act like a tax. The banks are hurting as a result. In fact, the banks are pleading with the central banks to stop with the negative rates. It's hurting them. The entire terrible situation, for example, with Deutsche Bank in Europe, in Germany, is due to ECB policy. And I've said here in videos that I've done many times that the Fed's own survey of the banks, asking the banks, hey, what's the ideal level of reserves you'd like to see? They say 600 billion. So why is the Fed keeping it at 1.5 trillion? What's the sense of doing a survey and asking the banks, hey, where do you want reserves? And they tell you and you're like, okay, we're just going to ignore that and put it up much, much higher. They don't need all those reserves, and as a matter of fact, when they have levels that high, those reserves need to be financed with higher levels of capital in order to meet regulatory constructs. It's crazy. All right, we're in bullish mode. Everything's going well. Go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Everybody, have a nice weekend. I'll see you on Monday. Bye.